Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, July 7th, 2023. S&P 500 currently sitting at 4430. I'm David Zarling. I'm here with a proponent of universal basic landscaping installation costs, Ian McMillan. Plenty to cover from this week. And one of the things I appreciate about you, Ian, is you're continually curious. Is there anything market related that caught your eye or that you're curious about, or a place that you want to take us for our listeners, our clients, and those interested in what we're up to?
Yeah, I think we've been in a nice rally, obviously, as everyone knows. I've kind of gotten up into some previous highs. We had a little bit of sell the last 2 days. I mean, S&P basically, sideways over the last couple weeks.
Yeah, same level as June 15th is a fair way to say it.
And some good things, some bad things. I still think that there continue to be mixed signals. Again, it's not the best breadth picture. I know we have days here and there and spurts of lots of participation. Not the best breadth environment that I've ever seen. Not the breadth environment I was hoping for. But at the end of the day, price is price. Continue to be in an uptrend. Again, today looks like it's going to be a great day for quote unquote the average stock. Yesterday, I could say the opposite. So back and forth, but major indices continue to kind of hold in there.
For sure. And you've got important stocks like Microsoft and Apple. You mentioned yesterday. Yesterday was probably the biggest downside breadth day that we've seen since March.
And 88? Did we close at 88? We were at 88-ish, 90 maybe that was like at the lows of the day, though.
At the lows of the day. We didn't close that far off. It was more like a 70% down day yesterday. But it was one of the larger. Yeah.
But definitely a bad day. It was one of those where, the index is down, 60 basis points and your stocks are down 2%. So right. It was a bad breadth day.
Yeah, and from a breadth perspective, we hadn't seen something that weak since March, which our listeners are familiar with, kind of marks the mini banking crisis era. And to your point, seeing it rebound this quickly the next day after and seeing small caps actually lead the day following, that's not necessarily bear market behavior. You would typically see follow through on something like that. And we haven't seen that. And so it'll be interesting to see the weeks and months to come.
As I said, they did come in and buy the dip. So
right. And that's what matters is price. What is price doing? Are you getting follow through on negative breadth days like that? And we don't seem to be getting that. Now, we're still hour and a half away from close. Could happen. I'm not here to tell the market what to do. But if small caps are participating, they may not have to be leading, but if they're participating, the breadth picture remains supportive of bull market behavior. And then you've got things like Apple and Microsoft, the two biggest and maybe most important stocks in the world, continue to hold up. When I think about that negative breadth day yesterday, July 6th, and Microsoft is up, I think that's worth paying attention to as well.
Microsoft has had since mid-March. I take that back. Apple, since mid-March, one daily close below its 20-day moving average.
So it's
a strong uptrend.
It's a strong uptrend.
Yeah, at some point it ends, right? And that sounds like a lot, right? Oh my gosh. Apple's up how much off the 2022 lows? 56% since
it's too much, Ian.
January 3rd, December, let's say the beginning of the year. Literally the beginning of the year.
It can't possibly continue. It's too much.
But when you look back over the last however many days, I mean, we go back to the 2021 highs. 600 days.
Right. It's just now providing
You're at
a period
4%
of, right.
over the last year and a half.
Your return on Apple after over a year and a half is 4%. So you're telling me it's limited? That probably tells me your time frame is different than our time frame.
Yeah. I mean, there's a big difference between a daily chart, which looks extreme from a visual perspective. A daily chart on something like actual on Apple looks extreme. I get that. It's been a strong run. But when you go out to a weekly and monthly chart, has it been a strong run? In the grand context of multi-year trends.
Right. It could just be getting started.
Yeah.
And so time frame matters. And for our clients and for those near or in retirement, we're not sitting here day trading because our time frame is 6 months.
Yeah.
Like even as a retiree, if your time frame is bigger than 6 months. And if it's not, obviously we have a financial plan that works around that. But for the sake of what Ian's talking about in Apple, like until May of this year, Apple had gone nowhere for, like you said, almost a year and a half.
Yeah.
So a 0% return on Apple with heartburn in between for a year and a half, it's not too far too fast. Doesn't have to be.
No, in the grand context of, again, what bull markets and bear markets are, which are multi-year trends, we haven't gone so far or too far too fast. And they continue to be leaders. I'd say Russell, I mean, still relatively kind of down in the same range it's been in for all of May, all of June.
And even arguably all the way back to the COVID lows.
Yes, we are back. The COVID lows, I mean, we are right there.
And when you look at something like Apple versus small caps, right, we continue to make new highs. And it's a little bit like Christian Yelich playing like 2018 Christian Yelich on the Brewers. It's good to see all-stars doing well while the other parts of the lineup are holding up. So it's not like small caps are just crushing it, but they're holding up enough while Apple's performing. That's a good combo.
And, you know, Russell, that's not my favorite child right now, but, you know, it continues to find its support at 180. Short is hanging in there. Banks still worry me a little bit just from this fact. They're having a good day today. They're a leader today. I still think they're a little broken as a whole.
That's not necessarily an uptrend.
And they're down today. And I wonder how this plays out. For small caps, it's certainly a headwind right now, is biotech.
Oh, yeah.
Like you take an IB, I mean, we're on a huge, so far, it's 2:30 in the afternoon, but this is looking like it's going to be a good participation day.
Right. And
absolutely one of those things, and banks are up great today. One thing you would expect especially on a day when small caps are up almost 2% and the NASDAQ's up 0.5%, the S&P's up even less than that. One thing you would typically expect is participation from something like biotech. And they just continue to, certainly year-to-date relative lows, just a really lethargic showing from that area.
Oh, for sure. Like when you're seeing small caps perform well and biotech's not performing with it.
Yeah, little odd.
Yeah, it's
serious underperformance.
And we can look at pharma, biotech-related areas like Moderna and Pfizer. Hate to pick on those, but I don't hate to pick on those. But Pfizer, I mean, continues to roll over and be a false breakout on a massive base. So this base goes back to 2000 that it failed on Pfizer. Going back to 1999, we broke out. We've since failed. I'm wondering what the next 6 to 18 months brings from that type of firm. Now, that's not a biotech. I want to be careful. I'm not saying Pfizer's a biotech.
Moderna is.
but Moderna is. And Moderna is right on the edge. Like we are at the same price levels or below that we saw in March of 21, near December of 2020. And
That's a pathetic looking chart given what this broad market has done the last. I mean, even year to date, look how much it's down. If you go from the mid-December highs, we're down 47% off the late 2022 highs, December 15th, December, whatever. We'll call it mid-December. You're going from 212 down to 119.
right. And we're big on relationships, right? We're going to look at ratios. And you look at something like healthcare overall, XLV versus the S&P 500. If we use ratios, we can track that on a chart and see when that's in a trend. And here you have something on the verge of breaking its 23-year trend.
Yeah. And that's healthcare's weak is not some place. And there's other spots. For example, the ETF owns Boston Scientific, which has been a great outperformer.
Or Eli Lilly.
There have been spots, but as a whole,
good way to put it, as a whole,
not somewhere. Now, I will say as a sector, doesn't get a lot of attention. Not a lot of people are paying attention to it, but it's been really strong. I mean, it's up there with sneakily with tech as far as an absolute basis and getting to new all-time highs has been industrials.
Oh, yeah. Industrials hasn't gotten a lot of attention recently. You look at going back to healthcare, just how weak it's been. Industrial is quite the opposite. S&P, not at its previous highs yet, but here we have something like XLI representing the industrial sector right up against its all-time highs. It's gotten there first. That's relative strength. It's not necessarily bearish to see industrials performing well.
And transports, again, this is coincidence or not. We just finished the fact sheet for the second quarter on the ETF. Largest sector weighting is industrials. I think it's close to 30 or 33%. So momentum there, even under the surface, seems to be happening.
Well, and industrials is a economically sensitive area. It's a cyclical area. You typically see that do well when you have economic expansion, which doesn't fit the narrative of, isn't it interesting that the question in financial media is, do we get a hard landing or a soft landing? What about no landing?
If life just goes on, we just keep tracking and whatever happens, happens.
Right.
And we can adjust to new information that we're given.
Exactly. And
I love that. Would we even know? We never even know till after the fact.
Correct.
But no one's paid on. I mean, I've never been paid money by a client on knowing, positioning the portfolio on what happened 2 years later.
Right.
Got to be honest. Maybe you have, Dave. I have not.
No. It's more on what's the market pricing in now. That's a future discounting mechanism 6 to 12 months later. And I appreciate that you brought up the Adaptive Select ETF, ticker ADPV, because they're one of the supporters of this podcast. And Adaptive Select helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends.
So it's good.
It is. Yeah. Investors can find out more by looking at adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. Adaptive Select ETF is distributed by Quasar Distributors, LLC. Thank you for letting me pause for...
No, that's cool. So it'll just go to cash for you.
Yep.
In a downtrend.
In a downtrend.
And you don't have to take the tax hit.
Yep. It's happening within inside the ETF. The more tax efficiency happening within it. We like that. Our clients like that. It's not for everybody. Investing involves risk, of course. We're all adults here. Anybody listening to this, and even if you're 6 years old and don't have your minor Roth IRA set up yet, investing involves risk.
A minor Roth IRA
Yeah,
that starts at 6.
Well, no, it doesn't start at 6. You got to have
Oh.
someone that is at an age and is earning income. You can't just
Okay.
start a Roth. You have to have income. So someone who's, babysitting or working at Culver's, or what's the place down south? What was the place you were talking about?
Bojangles.
Okay, Bojangles. You're working at
Yeah.
Bojangles,
Had
and you're
Bojangles yesterday for lunch. Thought about you guys.
Was it good?
Was good. It was good.
That's the biscuits place.
It is. It's the place with the good biscuits. Yep.
Okay, so let's say my daughter, she's, I don't know, 14, 15 years old. Obviously, there's labor laws, but like she can work a certain amount of time per week. She's earning an income, right? I can open a minor Roth IRA, and we could start putting away our savings, even as that type of young of an age, and start earning based on what the market's doing. I think that's a good thing, Ian.
It's an amazing thing.
That's America.
Hey, I don't know how many other countries you can do that in, but
Right. It's amazing. It's the golden age of investing.
Isn't it? It's almost frictionless to be able to, outside of I think it takes you about, I'm going to say 3 to 4 minutes to create a brokerage account on Schwab. Maybe another 2 minutes to link to a bank account. 0 commissions now. Almost frictionless investing. It can be good or bad, but if used appropriately, a lot of potential there, I think, compared to previous generations. I think my dad used to pay $100 for a trade.
Yeah, and I know my pops had to pay a front end load.
There you go.
Just to own a mutual fund, and you had to have a minimum investment. So you paid like $2,000 to invest $10,000, and you might have saved 3 years just to be able to put that money in there. And now you can buy a fractional share
shares, man, for free.
Right. Wild. Don't complain to me about America when you have all these things that you have access to as Americans.
Yeah.
I'm not here to listen to
you choose to take advantage of it.
Right. Best place on the planet for making decisions, having those decisions matter, and accumulating wealth.
Makes me want to celebrate. Let's just do another July. Let's do a July 7th.
Yeah.
I got some leftover fireworks, so
yeah,
I'm willing to yeehaw it up in the name of America again today.
Because I am real short people who complain about America. I think you got to be long and strong, because I'm sorry, the amount of things that are accessible to our kids, even us at our age, to be able to invest is incredible. Like things that my dad could only have dreamed of in his day. And it makes me wonder what there will be when I have grandkids. I'm excited about it. Yeah, I'm excited about it. What else, Ian? We briefly touched on stocks, S&P 500 holding important levels.
How about bonds?
Bonds are an interesting one. You look at something like treasuries.
You've got long-term treasury yields are moving above
a compression area. We've been compressing or in a range since late last year.
Yeah, since October, November last year, have held the 200-day moving average, which is an upward sloping moving average. So, right, we're in a long-term uptrend for all intents and purposes, and looks to be like they want to move higher. And that's right. And we see the opposite. When we look at bonds, you can pull up a chart of TLT. Again, chart that's been sideways since October, November, and now looks like it may want to break down. We were here in March and rallied a little bit, so we'll see. But again, and a very weak trend. We've spent the entire year kind of moving. So when we had a pretty severe downtrend in 2022, right? So at some point, even in a downtrend, you usually have to work your way sideways. We've spent the last 6, 7, 8 months doing that. And from, a technical perspective, right, we assume that trends are going to continue in the way that they arrived out of a consolidation. So as a technician, you kind of got to assume until the facts change, until we're above, I don't know, on TLT 109.
Right.
We continue to move lower in bonds, which, based on basic theory, you would continue your rates to move higher.
Yep. Rates move higher. And here, we're potentially on a new weekly close in 20 plus year treasuries using TLT that we haven't seen since November of last year. And then when you look at relationships, like if you look at bonds as an aggregate, so if we use an aggregate measurement like AGG, an ETF that's an aggregate bond index, and you compare it versus the S&P, the demand continues to be for stocks versus bonds.
Yeah.
And that's
a clear breakdown, a little retest there, maybe the last end of June here. But yeah.
And so
own stocks or bonds, I agree.
That's risk on behavior if you're going to choose stocks over bonds. And this is happening in an environment where sentiment was, hey, you need to own T-bills. And I'm not saying you shouldn't own T-bills. I'm just here to tell you that when you have stocks outpacing bonds, the risk now becomes an opportunity risk that the 5% that you could get from T-bills, are you risking owning those versus a market environment where are we finishing 15% higher from here? I'm not here to predict that. I'm just saying that as long as we continue in this uptrend above 4180 in something like the S&P 500, and you see a relationship like the S&P versus AGG aggregate bonds, you continue to see that upward trend. Your risk is now opportunity cost. And that's why we use relationship charts. I mean, these things matter.
They absolutely matter. If your objective is to beat some type of benchmark, and you can pick your own benchmark, you may get aggressive or as diluted as you want, pretty aggressive. But you want to be involved in the strongest areas. And just as I was telling someone yesterday evening, it's really hard to beat your benchmark if you're not involved in the strongest areas. And the only way to do that is to look at a chart. What's an uptrend?
One of those strongest areas that have come out of a base on a relative basis is something like digital transformation.
Yes.
Right? So we're seeing areas like blockchain, digital transformation, metaverse.
The crypto stuff seems to be back.
Right. That's risk on behavior.
Yeah. And if you got ARK and transportation making new highs, two totally opposite ends of pretty important as far as the risk on sentiment, but two totally opposite ends of the spectrum in regards to as what they own. I mean, not the worst thing I've ever seen for stocks. I'm not saying on a day-to-day basis it's the prettiest uptrend you've ever seen. I mean, it's been pretty strong. June was pretty strong. I don't know if that continues, but at that pace, a rate of trend. But, again, uptrend is an uptrend, and you got to participate in it.
Right. Polarity is polarity. You mentioned blockchain, some of these more risk on areas. When you look at Bitcoin, still at that 31,000, 30,000 level, moving in a range. If it breaks above 31,000, I mean, like how bullish is that for that area? Which typically, right, like it's not out of this world to say if Bitcoin's in an uptrend that's risk on behavior.
No. And on the opposite, you mentioned healthcare earlier, but you've got areas that are seen as defensive that are continue to be in pretty steady downtrends. Staples, utilities, some parts of real estate have turned around. But again, pretty steady downtrend, all things considered, from the areas you would want to see downtrends. Energy is still a little, it's definitely in a relative downtrend, but mixed though. I mean, you've got small cap energies making new relative highs, coming out of a short intermediate term base today, and you've got energy. So that's certainly one of the places where some areas are better than others. But for the most part, again, industrials up there, discretionary.
And is that bearish behavior if there's more demand than supply for discretionary stocks?
Well, and it hasn't been Amazon. I mean, Amazon's been strong, but I mean, there's been a lot more to it from a discretionary perspective, a leisure, not necessarily retail. We're not talking about always buying and going clothes, but from a leisure and discretionary spending, some really strong uptrends out there. I mean, when you look at things like the cruise lines or casinos and gaming, or, there's just themes out there. Airlines have been really strong. That's probably fit into the transportation theme and the industrials theme, but yeah, again, pretty strong.
For sure. And then you think about yesterday's dip from a near-term perspective is what I mean. Was it just optionality pricing, right? And the one way we can gauge that is just looking at something like the VIX, which is a measurement of volatility, something like the S&P 500. When you look at the behavior of that, and I know I'm speaking controversially for some that you can't use technical analysis on the VIX, but I think that's frankly poppycock. You look at an area like 15 on the VIX, which was important all the way through 21, coming off of the COVID lows. And now we're printing a potentially bearish engulfing
that candle today. Yeah.
On that candle today. And so was that just a brief repricing in option premiums, right? Because there's always complacency in markets at certain points of time. This move, as you mentioned earlier in the podcast, pretty aggressive, and we've cleared important levels. I'm sure there's been some pulling back on using options to express certain thesis, whether it's to collect income or protect current positions. And was it just a few day respite on that pricing? And now we continue to cool off in volatility, which tends to be behavior you see in a market that continues to melt up. We'll see. Next week, we get more information from a seasonal perspective. The year, a pre-election year, summer tends to be at minimum tread water, but July also tends to be strong in that period of time. We'll see if that plays out. But for right now, the new quote unquote uptrend that's started once we cleared 4180 still intact.
Yeah. We talked about the 3 steps last week. I think you did a great job laying that out, kind of what the levels were.
And we're still there. We can't be blindsided either. It's not like we sit here and say, well, for sure, uptrend for the next 6 to 12 months. I think if we're keeping an open mind, are there things that have your head on a swivel? Are there things that you're sitting there going, if this level breaks, or if this relationship does this, I have some concerns and we have to manage risk with that. Are there any things that you're looking at? Like an example for me would be if we're breaking back below 4,300 on something like the S&P 500, that would be an example of that. Are there other things that you're looking at in that regard that you're sitting there? And if this doesn't play out, then maybe we have a different situation on our hands. Because I don't want to just be so myopic that, oh my goodness, it's just uptrend forever. We have to be thinking of the other side.
We know that this is clearly, you can look at tech or XLK, for example. We're up into all-time highs up here at 176. I think we mentioned it last week. Clearly, best case scenario is you consolidate here for a few weeks or however long. Of course, you could end up, I guess the best case scenario, I take that back, would you just keep going. the more logical, healthier scenario, maybe it's a better way to put it, the healthier scenario, if we want longer term setups out of a sector like this, is that tech consolidates here, maybe small caps and things like that play catch up. I mentioned earlier banks. The weakness out of banks is still a little odd. Sorry, Dad. I know you don't want to hear that, but it's just an area you'd like to see it do a little bit better than it is. Biotech, maybe up there, but yeah, biotech's such a mixed bag. I don't think that doesn't mean that indices can't continue higher. And I mean, I guess overall we continue to see Apple do pretty well. I mean, you don't want Apple to necessarily give up what it's done. A consolidation's fine. A sideways consolidation is fine. If Apple was somehow over the coming weeks and months, I think it would take a bit. I don't think it's going to happen real super quickly. But if Apple was to break back below 182, 180, I think that would be an eyebrow raiser.
Yeah, a little bit of a warning sign.
We can test that. It's not going to feel great. If Apple needs to come back and test 180, that's not going to feel great for broad indices. That's just, that's a 7% correction. So that probably means 7, 8, 9% for broad indices.
We could pull back into the previous highs for something like Apple, which would carry the broad indice with it, but still be perfectly normal.
Would be fine. And maybe small caps do great. Maybe we take a break for a couple months and Apple relaxes, but small caps go sideways or are slightly positive. That would be a great thing to see. Gold, I'm not too worried about gold. You had mentioned Bitcoin continue holding those anchor VWAPs from the highs. It's been consolidating here for a couple weeks. I think as long as it holds 26, 27,000, it's probably fine. I think you want to be there instead of gold.
Yeah, gold continues to be in this range that whipsaws around important levels from 2011 and 2012. Until this range clears for gold, there's nothing really to do there. You know, you got a trade weighted dollar that's actually getting pretty sold hard today. And when you look at on a 1 week basis, which is important information, it's a bearish engulfing type behavior. If we're breaking 101, 100 on the trade weighted dollar, that probably continues to be a tailwind for gold, Bitcoin, stocks as a whole.
Yeah, I assume it's a tailwind for both gold and Bitcoin, but you'd likely want to be long Bitcoin.
Right. It's worth noting that we continue to see risk on areas like discretionary and tech and transports and industrials lead, while utilities and staples and healthcare either are stable or move lower on a relative basis. And so the environment continues to have evidence of bull market behavior rather than bear market behavior, which we'd become so accustomed to prior to clearing 4180. And so we are always looking for what'll be interesting for me, I guess, is you look at swinging back to TLT or something like 20 plus year treasuries. If we're going to roll over here and we're going to see rates move higher, there was an environment in 21 and 22 where bonds and stocks sold off together. And this is something brought up by Dan Gorgruber on our team, is if we see bonds roll over here, specifically treasuries, do we see stocks go with it? That's always a possibility. And then on the flip side of that is you got junk bonds versus IEF, shorter duration government bonds that has been in a base for over a year, almost 2 years. If that breaks higher, how risk on is that?
Yeah. We decided we want to own U.S. Treasuries again.
Right.
U.S.
This is for sure. And it's I mean, it's interesting from a modern portfolio theory, which we don't ascribe to, that you could have U.S. Treasuries selling off, which is a pretty large component of aggregate bonds, and aggregate bonds on the verge of closing at their lowest weekly close since November of last year, that the 60/40 portfolio is not immune, especially, and we've harped on this how many times, Ian, I don't even know, I can't even count, that we're in a new rising interest rate environment.
Yeah. And that kind of tends, again, when we go with trends, I'm going to err on the side of the trend, and that continues to be where I kind of default. And we know that with rate cycles, 30, 40 years, that we should be kind of entering the next upcycle in rates.
Which changes the dynamic for the 40% of the 60/40 portfolio.
Well, yeah, I mean, think how many trillions of dollars of wealth were created with the 60/40 mindset. It's been fair. I mean, it's worked.
Right.
Bonds have gone up for 40 years. I get it.
And it was risk parity. It typically was non-correlated to equity.
You could run the bonds when you were scared, and they would offset your equity gains.
Right. And now are we in an environment where the 60/40 becomes an anchor, where it just completely pulls the whole portfolio down if you're trying to own bonds? Now, I get it from the standpoint of the yield generated. I'm not here to argue about the yield generated, but it does you no good if you're generating 3% yield and you're dropping 4%. And so it still matters on directionally what direction these bonds are moving.
It does. It kind of feels like it's one of those periods where you're going to have to, there'll be a time to lock in, maybe we go back to the 80s and you can lock in at 12%.
Right.
On your fixed income.
That'd be great.
But definitely more of or if you're going to hold to maturity, that's also an argument now. If you're in retirement age, how long are you holding on to 30-year bonds? That's for you to decide, right?
Yep.
So maybe not the answer for everyone. And I will say, we talked a lot about crypto, but there's that theory that when precious metals are truly in an uptrend, they're in a risk-on environment, you're going to see gold miners outperform gold, right?
Mm-hmm.
Well, you're not seeing that in the gold and precious metal, silver space, but you are seeing that in the crypto space. So I would actually say, again, anything can change. It's Friday, July 7th, and maybe on July 10th, this relationship changes. But we have seen in the crypto space over the last few months, and certainly here recently, where it has been more beneficial to own the stocks that quote unquote mine crypto versus crypto itself. So I think that is kind of another bullish scenario for the space overall.
Yeah, I like that. As you were saying that, I looked at something like BLOK versus Bitcoin. So like a blockchain, and you might have a better example than that, but I get what you're saying. You're saying we could be on the verge of a base being built, a change in trend or rate of trend, and that would be very bullish for the space overall, as if things like HUT and Mara and Coin are doing better than the coin itself.
Well, look at, you have DAP, DAPP, clients are familiar with, and then also WGMI. We're going to make it obviously a play on some crypto community slang there, but WGMI versus Bitcoin clearly in a nice uptrend, breaking to new relative highs over the last week or so. So again, period in time where I know cryptos are fun, but there's actually more alpha to be made in the individual stocks.
Yep, in the miners.
And again, it goes back to your point, and these are intermarket relationships that we look at. And, should we be putting money, should we be putting other people's money, clients' capital in this, or do we have a better chance at making them more money or potentially losing less money for another asset.
I mean, that's a great reminder that we're not involved with markets for fun. We're involved with markets for making money and preserving capital.
Preserving, yeah.
We're not just in here for the latest narrative. And so I love that. I love that example of, are we better off in miners versus the crypto asset itself? Those are great examples. So with that, we're almost to the end of our time. Anything else you want to highlight before we wrap it up?
No, other than the trend is up on a day-to-day basis. I don't think that we've come off a strong run. So relatively speaking, it feels like maybe we stalled or the market is spinning its wheels. At the bigger context, it's still a very strong, healthy uptrend. We covered the 3 levels. Last week, all of those boxes have been checked. Until one of those boxes, again, one of them, and Dave mentioned this, was 4,300. Until those become unchecked, we'll continue to hang out.
It would be perfectly normal if something like the S&P 500 moved between here and 4,300 now through August.
I was actually going to say that, beginning of September, do we take a breather? And it's sideways and it's uncomfortable, but
perfectly normal.
I'd rather move sideways for 2 months than have a 10% correction.
Yep. A correction through time versus price. And it would be perfectly normal to hold those August 22 highs and something like the S&P 500. Not opposed to that, but I'm also not here to tell the market what to do. And I know you're not either.
I wish
that if XLK and technology and the Qs and all those, Apple zoomed through their August highs and their March 22 highs and their all-time highs, if those are the leaders and that's what we're going to do, I feel for you if you're someone out there that's short this market and trying to get out. I wouldn't want to be on the other side of that either. So until then, the trend is your friend. Ian, I appreciate you. I love doing these things. Hope you have a wonderful weekend with your family. I know you're celebrating your son's birthday. I think that's fantastic.
Number 4, man. I cannot believe it's been 4 years. It's wild.
It's incredible. The days are long, but the years are short.
They are. That's why we're starting over.
I love it.
We're starting over with another one, I guess.
Yeah, I think Connor's going to make a great big brother. And I love that you guys are having that celebration this weekend. It's interesting, right? You're having a birthday party for your 4-year-old, and I'm having a graduation party for my 18-year-old this weekend. So It's going to be, time flies, and soon it'll be your turn to host the graduation party, and I can't wait for that for you.
Let's not talk about that yet.
Yeah, no, don't. Enjoy the moments. Don't wish away the moments. Like when you're in them, just enjoy them. I think it's great, and every chapter is the next great chapter. So appreciate you. Thanks for everybody listening. Of course, if you like this, make sure you share it with your friends, your family. Doesn't matter who to us. It's a way that you can pay us back for putting this time in and providing you guys quality information. So thank you.
Have a great weekend, everyone.